If you have dollars, retirement savings, or investments in the U.S., your money just entered dangerous territory. On Sunday, the Fed chairman was threatened with criminal charges and the market panicked. In less than 24 hours, the dollar retreated, gold hit historic highs, and silver, the thermometer of financial panic, rose 4%, while stocks fell. Your 401, your retirement, the price of gas you buy, all of this is now in uncharted territory. It's not about Powell, it's about the dollar. And when the Fed loses independence, trillions of dollars flee the United States. Fed attack, risk rises, dollar falls, long-term rates rise, gold and silver surge, your cost of living gets worse, and this is where everything changes. Jerome Powell, the man who controls the printing of dollars, recorded a video on Sunday night, the 11th of January, 2026, and said something no Fed chairman had said in over 100 years, that he was being criminally investigated by the Department of Justice. This directly affects your financing, your retirement, and the price of everything you buy. Powell didn't stop at the investigation. In a statement that moved trillions of dollars, he said this investigation was a pretext to force the Fed to lower rates as Trump wanted. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the president's preferences. Powell said, the market responded, as it always responds, to fear, defensive movement. And silver, which always detects financial instability before any other asset jumped while stocks retreated, capital moved quickly. The dollar weakened against all major currencies. Gold hit records. But it was silver that showed the real reaction. It rose in the first moments of trading, while S&P 500 and NASDAQ futures retreated. Although the indices recovered throughout the day and closed at highs, the initial movements revealed the real nervousness. Your savings lost purchasing power, your retirement faced volatility, your financing costs may rise. Markets registered what analysts called a sell America trade, like the world pressing the sell button on the US and buying anything that wasn't dollars. If you only had American investments in your 401 ICE, you lost real money that day. Observe what happened next. Within 48 hours came a signal from outside the US. And this is where most people get it wrong. They think this is just American politics. On Tuesday, January 13, something extraordinary happened. Central banks from 10 countries, European Central Bank, Bank of England, Canada, Australia, Brazil, Switzerland, Sweden, Denmark, and South Korea issued a joint statement defending Powell. Christine Lagarde and Andrew Bailey, along with other central bank presidents, said they were in total solidarity with Powell. When 10 central banks unite to defend the Fed, it's not solidarity, it's alarm. When was the last time you saw central banks from around the world uniting to defend the Federal Reserve's independence? Never, because it was never necessary. This directly affects your financial future. Former Fed chairs Ben Bernanke, Janet Yellen, and Alan Greenspan, along with former Treasury secretaries like Henry Paulson and Timothy Geithner, issued a statement condemning the investigation. They said these tactics are how monetary policy is made in emerging markets with weak institutions. In other words, the United States is starting to behave like Argentina or Turkey. And silver, it continued its advance because it's the metal that reveals what the dollar tries to hide. When global central banks do this, it's because they know capital is repositioning, moving away from where it doesn't feel safe. The danger isn't the process, it's the precedent. No Fed chairman in history has been the target of criminal investigation. Not during the Great Depression, not in 2008. This marks a moment that cannot be undone, and almost no one is looking at this. To understand why your money is at risk, you need to understand that this investigation is the culmination of a pattern that intensified throughout 2025. Your financial stability depends on this. During 2025, Trump publicly pressured the Fed to cut rates more quickly. He called Powell incompetent, compared him to a golfer who can't make a putt, and even suggested he had authority to fire the Fed chairman. With each attack, international investors watched with growing concern. Why? Because when Fed independence is questioned, trillions of dollars can leave the United States. In April 2025, this pressure escalated when Trump tried to remove Fed Governor Lisa Cook based on unproven allegations of mortgage fraud. The case went to the Supreme Court, which must decide on the legality of this action, still in January 2026. But Powell's criminal investigation marks an unprecedented escalation. The official allegation is that Powell lied to Congress about the cost of the $5 billion renovation of the Fed's Washington headquarters. But as Powell made clear, this is just an excuse. Here's the fundamental truth. The dollar is strong for a simple reason. The world trusts that the Fed will make technical, not political decisions. This trust allows the U.S. to print the currency the world uses as a reserve. It's an extraordinary power that keeps your inflation low and your imported products cheap. This means that when the United States needs money, they can simply print it, and the rest of the world accepts those dollars in exchange for real goods and services. This power exists only as long as the world believes the Fed operates independently. The moment this independence is questioned, the foundation of this entire system begins to crumble. And silver responded, showing exactly this, detecting the erosion of confidence before any other asset. Markets react to signals, don't wait for certainties. On Monday, January 12th, this became clear. According to market reports, the S&P 500 fell approximately 0.5%. NASDAQ fell about 0.8%. The dollar weakened against all major currencies. If you only had American investments in your 401, you lost real money. And silver responded with its characteristic movement, the instability radar functioning. When investors lose confidence in institutional stability, they reposition to real assets. Silver functions as a dual radar. It detects monetary inflation and industrial demand. That day, both signals were active, but the numbers tell only part of the story. Your costs increased, your savings lost value, your loans may become more expensive. Here's what changed the game. Krishna Guha of Evercore ISI said markets were stunned by this deeply disturbing development and predicted a resumption of the sell America trade we saw briefly in April 20. Lloyd Blankfein, former Goldman Sachs CEO, made a crucial observation. Attacking the central bank through a criminal investigation would damage multiple aspects of the American economy. Janet Yellen, former Fed chair and former Treasury Secretary, said she was surprised the market isn't more concerned and that using monetary policy to manage debt is the path to a banana republic. When the former Treasury Secretary talks about banana republic, you should be worried about your money. More importantly, gold and silver advanced. Why? Because when investors lose confidence in the institutional stability of a currency, they reposition to real assets that don't depend on government credibility. Silver functions as a dual radar, detecting both irresponsible monetary policies and real industrial demand. And that day, both signals were active. This puts your entire retirement and financing planning at risk. This is what analysts call a debasement trade. Investors buying tangible assets because they fear currencies will lose value due to eroding confidence in the institutions that control them. But Monday's numbers tell an even more specific story about where money is going and where it's leaving from. This directly affects your financing, your retirement, and the price of everything you buy. In equity markets, defensive sectors like utilities and consumer staples outperform technology and growth. This indicates investors are prioritizing stability over returns. If you have tech stocks in your 401, you felt this. If you only have growth funds, your retirement lost relative value. In the bond market, something interesting happened. Long-term bond yields rose more than short-term bonds. This indicates investors are starting to price long-term inflationary risk. If you're retiring in 10 to 15 years and have long-term bonds, you need to pay attention. Your long-term financing becomes more expensive. In commodities markets, it wasn't just gold and silver. Oil rose, copper rose, even wheat had positive movement. This suggests investors are buying real, tangible assets that maintain value even if fiat currencies lose credibility. And silver continued being the most sensitive indicator detecting instability before any other asset. In currency markets, the dollar weakened against currencies of countries with historically independent central banks, euro, Swiss franc, yen, but remained stable against currencies of countries with a history of political interference in central banks. This is no coincidence. It's the market making a specific distinction about institutional credibility. If you have international investments in your portfolio, you made money on Monday. If you only have American assets, you lost real opportunities for gain. And almost no one is looking at this. The question is that lost credibility doesn't come back easily. Countries like Brazil, Turkey, and Argentina took decades to rebuild confidence and never fully recovered. The U.S. has never faced this problem. Until now, this is exactly what happens when countries cross this line. For decades, Argentina had a prosperous economy and an internationally respected currency. But in the 1,970 seconds and 1,980 seconds, Argentine presidents began pressuring the central bank to print money to finance public spending. This puts your personal financial stability at risk. Initially, the economy seemed to benefit. More money circulating meant more economic activity in the short term. But gradually, international investors began to realize that the Argentine peso was no longer a reliable store of value. After all, if politicians could force the central bank to print money whenever they needed it, what would this currency really be worth in the long run? The result was devastating for any Argentine who had savings. Argentina faced multiple monetary crises, hyperinflation. And today, decades later, if you were Argentine and had kept pesos in the bank, you would have lost practically everything. Your savings evaporated. In Turkey, since 2018, Erdogan has directly interfered in central bank decisions, firing presidents who refuse to lower interest rates according to his preference. Erdogan argues, like Trump, that low interest rates are better for the economy. But observe the result. In 2018, you needed about 5 lira to buy a dollar. Today, according to market data, you need more than 30 lira. If you were Turkish and had saved lira in 2018, today they would be worth a fraction of their original value. International investors simply no longer trust Turkish monetary stability. The United Kingdom in the 1,970 seconds faced a similar crisis when the government tried to control monetary policy for political purposes. The pound lost value dramatically, inflation rose, and the country had to ask the International Monetary Fund for help, unthinkable for a world power. Other similar episodes included Mexico 1994, the Asian crisis of 1997, the Eurozone 2010 to 2012, always the same pattern when politicians interfere with monetary independence. In each case, ordinary citizens lost their savings, while those who diversified early managed to preserve wealth. And silver functioned as an early indicator in all these documented cases, rising before crises reached their peak. They demand extraordinarily high interest rates to lend money to Turkey, which makes credit expensive and stifles economic growth. Loan costs explode. Inflation erodes purchasing power. See what's happening now in the U.S. On Monday, January 12, we saw the first signs that similar dynamics may be starting in the United States. Although markets recovered throughout the day, the Dow and S&P 500 closed at historic highs. There were revealing movements behind the scenes that directly affected your 401. The dollar index fell 0.24% against a basket of major currencies. Treasury yields rose, indicating that investors may be starting to demand higher risk premiums to lend money to the U.S. government. If you have government bonds in your retirement portfolio, you lost money in this movement. Your money buys less. More importantly, international investors began positioning defensively. ETFs that invest in developed markets outside the United States rose 0.8%, while the S&P 500 rose only 0.16%. If you only had American funds in your 401, you lost real gain opportunities. And silver responded, maintaining its advance, the detector functioning perfectly. This suggests that, for the first time in decades, some investors consider foreign markets more attractive than American markets in terms of institutional risk. This directly affects your financial future. The question isn't whether Powell will be convicted. The question is that a line was crossed, and now there's precedent for using the judicial system to pressure the Fed. When this happens, if you have a 401, if you're planning your retirement, if you have dollars saved in the bank, all of this is now in uncharted territory. Tobin Marcus of Wolf Research observed that while a successful criminal prosecution seems highly unlikely, the mere fact that this precedent has been established is alarming. Your retirement is worth less. Your financing becomes more expensive. This is when markets enter defensive mode. If you're an average American with retirement savings, investments in your 401, or simply concerned about your money's purchasing power, you need to understand how these macro events can directly affect your life. Until now, the traditional strategy for Americans was simple. Invest in American stocks, American bonds, and American real estate. The dollar was automatically a safe store of value. But when Fed credibility is questioned, this strategy becomes riskier. On Monday, those who had international diversification won. Those who only had American assets lost opportunity. This isn't speculation about collapse. It's recognizing that concentrating 100% in a single currency has become risky. And silver, it continued being the radar that detects instability before any other asset. Even with the Fed keeping rates low, markets may demand higher premiums to lend to the U.S. We already saw signs of this on Monday when Treasury yields rose despite the Fed not changing its policy. If you have a house, car, or credit card finance, this could cost more regardless of what the Fed does. Your financing becomes more expensive. One of the reasons the United States has relatively low inflation is because the dollar is the world's reserve currency. This allows the United States to export inflation when they print dollars. The rest of the world absorbs part of the inflationary impact. But if the dollar loses this special status, even partially more, inflation stays retained in the American economy. If you have a family budget, gasoline, food, rent, you'll feel it directly. Your money buys less. To understand completely what's happening to your money, you need to see how we got to this point. This wasn't a sudden explosion. It was a gradual escalation that culminated in the January 11 event, January 2025. Trump assumes the presidency, promising to bring prosperity back through lower interest rates. He publicly signals that he expects the Fed to cooperate with his economic policies. March 2025. First public pressure. Trump criticizes Powell in an interview, saying interest rates are artificially high and hurting the economy. Powell responds by maintaining Fed independence. Silver advances that week. April 2025, significant escalation. Trump tries to remove Governor Lisa Cook based on unproven allegations of mortgage fraud. The case goes to the Supreme Court. Markets get nervous. International funds begin outperforming American markets for the first time in years. June 2025. Trump publicly suggests he has authority to fire Powell. Constitutional scholars contest this, but the damage to confidence is done. The dollar has its first weak against independent central bank currencies. September 2025. Trump compares Powell to a golfer who can't make a putt and suggests he is economically incompetent. Powell maintains his position, but international investors begin including Fed political risk in their models. November 2025. Pressure intensifies. Trump suggests the Fed should serve the American people, not special interests, a veiled criticism of the institution's independence. Silver has an upward movement, rising over 2 weeks. December 2025. Rumors that Trump was preparing a comprehensive investigation into Fed misconduct. Powell issues statement reaffirming independence. Markets become volatile. The 11th of January 2026, Powell announces he's under criminal investigation by DOJ. Markets react with concern. Silver rises rapidly. The 13th of January 2026, 10 central banks issue joint statement defending Powell, unprecedented event in world monetary history. Banks are most exposed to changes in Fed credibility. If the dollar loses reserve status, American banks lose global competitive advantage. Rising treasury yields mean loans become more expensive. If you have bank stocks in your 401, pay attention. Your financing becomes more expensive. Tech companies depend on cheap access to capital to grow. If yields rise and the dollar weakens, American tech companies become less globally competitive. If you only have growth funds focused on tech, your retirement may lose relative value. Energy, oil and gas are priced in dollars globally. If the dollar loses special status, energy prices may rise in the US, but American energy companies may benefit. Your energy bills may become more expensive. Real estate, prime location properties may benefit as real assets, but financing becomes more expensive if long-term yields rise. If you're thinking of buying a house, you may pay more for loans regardless of what the Fed does. Retail, companies that depend on imported products suffer if the dollar weakens. Walmart, Target, companies that sell products made in China come under pressure. The price of everything you buy may rise. And silver, it detects problems in all these sectors before they become obvious in quarterly reports. What's happening now has frightening parallels with 3 major monetary crises in modern history. And in all of them, silver anticipated the problems. United Kingdom, 1976. Labor government tried to use monetary policy for political purposes. The pound plummeted. Inflation soared to 25%. Country had to ask IMF for help. Took a decade to regain credibility. If you were British at the time, your money lost purchasing power dramatically. France, 1983. Francois Mitterrand tried to control the central bank to finance social programs. Speculators attacked the franc. Country was forced to abandon inflationary policies. Millions of French people saw their savings evaporate. Silver rose 40% before the crisis reached its peak. Mexico, 1994. Government pressured central bank to maintain artificial exchange rate. When pressure became unsustainable, the peso devalued 50% overnight. Crisis spread to other emerging markets. Those who held pesos lost half their wealth in a matter of days. The pattern is always the same. Government pressures, central bank, credibility is questioned, speculators attack the currency, crisis explodes. And silver always detects the problem before most people realize it. The difference now is that this is happening with the world's reserve currency. If the dollar loses credibility, there's no anchor currency to flee to. That's why gold and silver are rising. They're the only assets that don't depend on any government's credibility. But Monday's numbers tell an even more specific story about where money is going and where it's leaving from. This puts your entire retirement and financing planning at risk. Based on what we observed in recent days, the international market reaction to the Powell event shows that geographic diversification is no longer a luxury, it's necessary to protect your retirement. On Monday, international funds performed significantly better than American markets. Those who didn't have global exposure lost real money. This isn't speculation about dollar collapse. It's recognizing that concentrating 100% of your wealth in a single currency, even historically the most stable, is now riskier than before. Developed foreign markets offer exposure to economies with central banks that maintain solid international credibility. Protection via precious metals isn't speculation, but insurance against erosion of your savings purchasing power. Prime location real estate can also benefit, as can REITs that historically preserve value during periods of monetary instability. And silver continues being the most sensitive indicator of all these changes. The events of this week show we should expect periods of greater volatility as this situation develops. This means maintaining larger emergency reserves, perhaps 6 to 12 months of expenses instead of the traditional 3 to 6 months. It also means being psychologically prepared to see larger fluctuations in investment values without panicking or making impulsive decisions. If you didn't understand how monetary policy affects markets before this week, you need to learn quickly. The next decisions about your investments will be more important than many choices you've made in recent years. Dedicate a few hours per week to understanding how exchange rates work, how inflation affects different asset classes, and how geopolitical events move markets. And here everything changes. Now, if you have retirement savings, if you have financing, if your life depends on dollar stability, watch these indicators in the coming weeks. How the dollar behaves against currencies of countries with independent central banks, euro, Swiss franc, yen, whether treasury yields continue rising even without Fed policy changes. More importantly, if silver stays high, it's the most sensitive thermometer, always detecting financial lies before any other asset, how international funds perform compared to American funds. These indicators will tell whether this was an isolated episode or the beginning of a lasting trend. There are three main scenarios that could unfold in the coming months, and each has different implications for your money. This directly affects your financing, your retirement, and the price of everything you buy. If Trump continues pressuring the Fed, if the investigation advances, if Powell is forced to leave or give in to political pressure, we're entering uncharted territory for the United States. In this scenario, international investors would begin treating the dollar as an emerging market currency subject to political interference. The result would be an acceleration of the sell America trade. The dollar would gradually lose value. Treasury yields would rise to compensate for perceived risk. Gold and silver would continue rising as investors fled dollar-denominated assets. If you only have American assets, you would lose real money. Your financing would become more expensive. Mortgages, loans, credit cards, all would rise regardless of what the Fed did. Inflation would accelerate as the dollar lost its special status. Your retirement would be worth less in real terms. If Congress defends Fed independence, if the judicial system protects Powell, If Republican senators continue refusing to confirm Trump's politicized substitutes, American institutions could emerge strengthened from this crisis. In this scenario, after an initial period of turbulence, investors would gain renewed confidence in Fed independence. The dollar would stabilize, markets would calm down, but still, a line would have been crossed. Investors now know that Fed independence can be attacked, so they would continue demanding small risk premiums. The most likely and potentially most dangerous scenario is a middle ground where political pressure continues but doesn't reach the point of removing Powell. A war of attrition where Fed credibility is constantly questioned without clear resolution. This scenario would create permanent uncertainty. Investors would never know when the next political pressure would come. The result would be persistent volatility, gradually weaker dollar, and the need for higher risk premiums to attract international capital to the United States. And in all these scenarios, silver will continue being the system's lie detector, rising every time confidence is shaken. This is when investors seek protection. Don't make drastic decisions based on a week of markets, but also don't ignore the signals. The smart strategy is to make gradual defensive adjustments to your portfolio, maintaining flexibility to adjust as events develop. Remember, investors who prospered during major historical changes were those who recognized trends early, made prudent adjustments, and maintained long-term perspective. This impacts your financial situation directly. If you're a few years from retirement, you're most vulnerable to these changes because you don't have time to recover from significant losses. The fundamental principle is to reduce exposure to growth assets and increase defensive positions. This generally means fewer tech stocks, more utilities, fewer long-term bonds, more short-term bonds. The concept of diversification becomes crucial. Consider small exposure to real assets, commodities, REITs, precious metals. Silver, specifically, has functioned as insurance against monetary instability, not as speculation, but as protection. If you have investments totally concentrated in American funds, the principle of geographic diversification becomes important. Developed market funds, Europe, Japan, offer currency diversification and exposure to central banks with solid credibility. If you're mid-career, you have more time to adjust, but also need to protect what you've already built. The balanced strategy maintains most investments in growth assets, but adds defensive components that weren't necessary before. Financial education about international diversification becomes essential. Use crisis moments as opportunities to understand geographic diversification. Studying how developed markets behave relative to American markets offers valuable insights. In environments of greater volatility and monetary uncertainty, the principle of more robust emergency reserves gains relevance. Traditionally, experts recommended a few months of expenses. In uncertain times, this period may need to be extended. If you're starting to invest, you have the advantage of time, but are also building wealth during a period of potential monetary system change. Use this to your advantage through education. From the beginning, the concept of building a globally diversified portfolio becomes fundamental. Don't make the mistake of previous generations of assuming American investments are automatically safe. Moderate international exposure in new investments offers protection. Learn about real assets, commodities, precious metals, real estate. You have decades to benefit from long-term trends. If the dollar really loses its special status over the coming decades, understanding real assets could be crucial protection. And always observe silver. It will be your barometer of financial instability throughout your entire investment career. Educate yourself about monetary policy and geopolitics. The next 2 decades may be very different from the last two. Understanding how central banks work, how currencies interact, and how political events affect markets is no longer luxury, it's necessity. Maintain flexibility. Don't marry strategies that worked in the past. The January 11 event may have permanently changed the rules of the game. This directly affects your financing, your retirement, and the price of everything you buy. In the coming months, some indicators will be more important than others to determine whether this crisis deepens or resolves. As an ordinary person concerned about your money, you don't need to be an economist to follow these signals. This directly affects your financing, your retirement, and the price of everything you buy. Track the DXY dollar index weekly. If it continues falling consistently for more than a month, it indicates international investors are losing confidence. Your money buys fewer imported products. Observe the 10Y2Y spread, the difference between 10 and 2-year bonds. If this difference continues increasing, it means investors are pricing long-term inflation. This suggests loss of confidence in the Fed's ability to control inflation independently. Your long-term financing becomes more expensive. Silver price versus gold is fundamental. Silver traditionally rises more than gold during monetary panics. If silver continues rising more than gold, it indicates panic is intensifying. It's the most sensitive thermometer. The VIX volatility index at levels above 25 for more than a week indicates persistent nervousness. Your retirement becomes more volatile. International ETFs versus S&P 500 show preferences. If European and Asian funds continue outperforming American markets for more than a month, it indicates structural change in investor preference. If you only have American assets, you continue losing opportunities. Treasury yields without Fed changes reveal risk premiums. If 10-year yields rise, even without the Fed changing policy, it indicates markets are demanding higher risk premiums to lend to the U.S. All your loans become more expensive. TIPS versus normal treasuries prices future inflation. If TIPS begin yielding more than normal bonds, it indicates investors are pricing future inflation. The price of everything you buy may rise. Foreign central bank statements signal global seriousness. If more central banks issue statements defending independence, as 10 countries did, it indicates the crisis is being taken seriously globally. Senate positioning determines institutional resistance. If Republican senators continue refusing to confirm Trump substitutes, institutions are resisting. If they begin giving in, the crisis deepens. And always observe silver. It will be your lie detector throughout this entire crisis. This is when financial decisions become crucial. If you have more modest wealth, the focus should be on basic protection principles. The concept of robust emergency reserves gains importance, including understanding how different currencies behave during crises. Avoid unnecessary debt, credit cards, luxury car loans. If rates rise, these debts become more expensive. For retirement plan contributions, many experts discuss the importance of basic diversification, a solid foundation in domestic assets, moderate exposure to international markets, and small positions in real assets like commodities. It's a diversification concept previous generations didn't need to consider. With intermediate wealth, the opportunity arises to understand more sophisticated strategies. It's time to educate yourself about vehicles that offer exposure to precious metals, commodities, and foreign markets through different investment structures. The study of diversification for new contributions reveals important principles. A solid foundation in the domestic market, significant exposure to developed international markets, smaller positions in emerging markets, and exposure to commodities and metals. This illustrates protection against monetary concentration without betting against national success. The concept of reserve diversification also deserves attention. Beyond domestic currency, many consider smaller exposures to stable currencies like euros and Swiss francs. Financial technologies facilitate this approach. With higher wealth, education about sophisticated strategies becomes relevant, including specialized advisory and international diversification. The concept of accounts in countries with historically independent central banks, Switzerland, Singapore, deserves study. Education about monetary diversification reveals important principles, avoiding excessive concentration in a single currency. Many consider moderate exposures to currencies from countries with stable monetary policy. This illustrates protection against concentration without betting against domestic success. Understanding real assets also becomes relevant. Commodities, precious metals, real estate in different geographies. Some assets like silver offer specific characteristics during monetary instability. Financial education has become critical. Dedicate 2 to 3 hours per week to understanding how currencies, central banks, and geopolitics affect investments. This is no longer luxury, it's financial survival necessity. Prepare psychologically for greater volatility. The next 2 to 5 years may be very different from the last 20. Markets that rose consistently may have periods of decline. Strategies that worked may stop working. Maintain long-term perspective. Monetary crises resolve but can take years. Those who position correctly prosper. Those who ignore signals suffer. And never forget, silver will be your thermometer throughout this entire crisis. When it surges, it's because it detected problems before they became obvious. When it stabilizes, it's because markets are gaining confidence. The history offers clear lessons about how ordinary people protected themselves during monetary crises. And in all of them, silver functioned as an early detector of problems. This directly affects your financing, your retirement, and the price of everything you buy. During the 1992 sterling crisis, George Soros made $1 billion betting against the British currency. But ordinary people who had diversified to German marks and Swiss francs maintained their purchasing power. Those who had everything in pounds lost 15% overnight. In the 1997 Asian crisis, countries that maintained artificial exchange rates saw their currencies plummet 50-70%. But citizens who had saved dollars or gold preserved wealth, silver rose 25% during the crisis, detecting problems before they became obvious. During the 2010 to 2012 Eurozone crisis, Greeks and Portuguese who kept euros lost less than those who tried to maintain only local currencies, but those who diversified to Swiss francs and Danish crowns did better. In all these crises, the pattern was similar. Governments pressure central banks, credibility is questioned, speculators attack, ordinary citizens pay the price. But those who diversify early protect themselves. The difference now is that this is happening with the world's reserve currency. There's no direct historical precedent, but basic principles remain. Diversification protects, concentration exposes to risk. The hardest part isn't the technical strategies, it's psychological preparation to accept that the world has changed. Your financial life depends on this. For 80 years, Americans assumed the dollar would always be the world's safest currency, that U.S. Treasury bonds would always be the safest investment, that the Fed would always be independent. These assumptions may no longer be valid. This doesn't mean the United States will collapse. It means the rules of the game may have changed permanently, and you need to be psychologically prepared for this reality. Silver, as always, will be your guide during these changes. When it rises, pay attention. It means it detected instability before it becomes obvious. When it stabilizes, it means markets are gaining confidence. What happened on the night of the 11th of January 2026 wasn't about construction costs. It was the first time in over a century that Fed independence was directly attacked by American political power. A line was crossed, the world saw, institutions reacted, and sophisticated investors, sovereign funds, central banks, global asset managers already include Fed politicization risk in their models. Institutional money has already moved. Only the public hasn't realized it yet.